Hey guys, how's it going? It's Sunday afternoon, which means it's time for another weekly options trade idea video. And not a lot of interesting stocks this week that have earnings in my opinion. I mean, the only one I am really looking at is Micron, the honey badger, if you've been watching some of my videos lately. And that's going to be this Tuesday after market close. Really the only other company that I see is Pepsi, but I really haven't been paying much attention to Pepsi or Coca-Cola. And I know Bed Bath & Beyond has been somewhat of a meme stock. It's been relatively popular on the internet forums, but I personally am not a fan of the company. I don't shop there, and so I really have no interest in Bed Bath & Beyond personally. So really the only thing I'm going to be looking at this week is Micron. So let's get right into it, and let's start off by looking at the Robinhood options chain to see how juicy the premiums are right now. So taking a look at Micron, the reason why I call it the honey badger is because it seems that Micron just does whatever it wants to do. It doesn't care what the overall market is doing. And just as a case in point, here's the heat map for this Friday, the last trading day. And you can see the whole market is pretty much green. I mean, big tech was up. All these semiconductor stocks were up except for Micron. Micron was down 0.7%. And then there were days earlier in the week, if we go back to Robinhood here, where the whole market was red, but Micron was in the green. So it seems like Micron just kind of acts opposite to whatever the whole market is doing, which is a little bit interesting. But let's just take a look at the 1 month chart here. You can see overall for the past month, Micron has been up a little over 8%. For the past week, it's actually down 1%, actually a little over 1%. And just looking at the overall graph, like the 1 year and the 5 year graph, you can see that Micron is trending up and to the right. Looking at the yearly graph, yes, it had a really big sell-off during the illness season, and of course, I mean, the whole market did. Micron went from about almost $60 in February down to a low of mid $34, and we are able to rally up to about 50, but we are not back yet at pre-illness highs. So something to keep an eye on. And again, from August to August 21st, you can see you had a pretty significant sell-off as well in Micron. But that was related to Micron specifically and not to the overall market. But looking at the analyst ratings, a lot of people think it's a buy. 71% of analysts right now say it's a buy. The one thing that does worry me a little bit is that Micron, if we take a look at their past earnings, their earnings have actually been relatively close to their estimates. And it's interesting because on Robinhood, you can see that the actual earnings are better or pretty much equal to their estimates on the past 3 earnings sessions. However, if we take a look at TradingView in a second, it actually shows that Micron did not beat earnings the past 3 sessions. So we'll have to take a quick look at that. But let's get right into the options chain to see exactly how juicy these premiums are since we have earnings coming up. So if I wanted to sell a cash good put for this Friday, October 2nd, let's just see, I would collect $194 in premium for $4,900 in risk, because this is $1.94 per share, and every contract is 100 shares. So you have to multiply this number by 100. And again, this is $49 per share. And again, 100 shares, so you multiply that by 100. And really, that's going to be $194, right, divided by $4,900. And that is going to be a return on risk of almost 4%, which is really juicy, actually. So I'm really looking at this closely because those are some really nice numbers, especially because earnings are Tuesday after hours. So you could honestly open a position on Monday morning and then hopefully just ride it until you get IV crush on Wednesday morning and sell it off if you really wanted to. But let's just see what strike we would have to get in at if we wanted to get in at, let's say, at least a 0.4% return on your risk. So let's take a look at $43. So that's $20 in premium divided by $4,300 in collateral. So that is pretty much exactly, actually a little over 0.4, just about 0.5% return on your risk. And I think 43 would be a relatively safe strike even if Micron does dip, because let me show you my technical analysis on TradingView. And I actually recently made a video on a complete 10-minute technical analysis on Micron the other day. So if you haven't seen that yet, go check it out. But let's go to TradingView right now. If we switch over to Micron here, we can see that I drew some technical analysis. Again, there's a full 10-minute video that I posted a few days ago on my YouTube channel, so you can check that out. but right now I think there's a gap at about $46 to $48, and we closed the day on Friday right at this Fibonacci level, pretty much just a little over $49. I think there's going to be an area of support right now at 49. So if Micron does well or has a huge run up to earnings, I think we're going to bounce up and off this, either this Fibonacci level here at 49, or I think there's also a trend line here a little higher up, a few pennies more in the mid 49s. So I think these are probably the same area. So somewhere in the low to mid 49s, I think is going to be an area of support, hopefully. What I hope that doesn't happen is that Micron has bad earnings and we break through this, and this is actually not support, but it's actually resistance. Because I think if that happens, there's a gap here between about $46 to $48. So I think if we break down below 49, then we might end up filling this gap all the way down to 46 at least. Now, the reason why I thought $43 was pretty good is because if I zoom out here, I thought there's an area of support at about 44.50, 44.60, and I think there's another area of support right at $43. And this $43 trend line corresponds, if I zoom all the way out, to the 50% Fibonacci level, as you can see here. So I think that's a pretty significant area of support there. Now, that's why I say $43 is probably a fairly safe strike, because in order to get there, especially in just a couple of trading days, Micron have to bounce off 49, fill this gap all the way down to 46, which it could do in one day if the earnings session is not very good. But then it would also have to break through this area of support at the mid 44s, and then also touch or break through this area of support at the $43 strike price. So I think it would take a lot. I mean, it would, in my opinion, take a very bad earnings session for Micron to do all of that in a few trading days. The other thing that kind of is contradictory to that is that Micron, I believe, supplies the parts for NVIDIA. And NVIDIA has been doing really well lately. So you would think that a rising tide raises all ships, right? So if NVIDIA keeps rising, then it's going to take Micron with it. So taking a look here at the bottom right, this is what I was referring to, that on TradingView, it actually shows that the past earnings sessions, the actual value was less than the estimate. So I have to do a little bit more digging to see if I believe Robinhood or do I believe TradingView. But, you know, nonetheless, it hasn't been that far different from the estimates, whether it was above or below. So I feel like since its estimate is 0.98, I'm assuming we will get somewhere near that value again if looking back at the past year's worth of earnings. But that doesn't matter too much to me right now. Those are really my thoughts on Micron. If I were to sell a cash grid put, I'd probably want to get in at $43 or less as a strike price to be safe and still collect a pretty good return on your risk of 0.5%. Now you might be saying, well, that's not really that great, right? 0.5% a week is not great. Actually, it's not that bad, because if you can do that every week for 52 weeks, that's at least a 26% return on your risk, not accounting for compounding week to week. Now, the other thing you could do, if we go back to this options chain, is say, you know what? I don't want to sell a weekly option. Why don't I try and scalp a little bit more premium by selling an option that's 2 weeks out? So let's just take a look at the following Friday, October 9th, and just keep in mind this number is $1.94, okay? So if I look at options for the following week, you can see it's not that much more premium. It's only $2.19. So $2.19 minus $1.94, it's only $25 more in premium. So if you were able to collect max profit in 1 week, you would collect $194. If you were to collect max profit in 2 weeks, you'd only collect an additional $25 the next week. So it's really not worth it, because would you rather collect $194 in a week or $194 1 week and then only $25 the next week? I mean, if we average this out, $219 divided by 2 weeks, that's only $109.50 per week, right? Whereas if you just sold a weekly for the first week and you're only tying up your capital for 1 week, you can get $194 in max profit potentially. Just out of curiosity, let's say we look at a monthly at October 30th. So that's, again, just $299. So now you're going out 1, 2, 3, 4, 5 weeks out, and you're not even collecting, you know, barely double a 1 week premium. $194 times 2 is $388. So you're going out 5 times longer in time, but you're collecting less than double in premium. So that, my friends, would not be a good, efficient way to sell premium, in my opinion, because I feel like I could get more efficient return on my capital by just selling it weekly right now on Micron. But the other thing I want to talk about is longtime viewers know that I have 200 shares of AMD and 200 shares of Space. And so I was really struggling to decide what I thought I wanted to do in terms of selling covered calls for this coming week. And the weird thing, both of these tickers went up this past Friday. There's rumors of a stimulus bill that's in the works right now. And my concern is if I sell my covered calls, let's say Monday morning, and then the stimulus bill passes Monday afternoon or Tuesday or Wednesday, and the stock market rallies hard, well, I'm going to have left a lot of money on my table, because if I could have sold a higher strike price or a strike price that's closer to the money now, I would have collected more premium. So part of me kind of wants to wait and see what the deal is with the stimulus bill and if it passes early next week before I sell my covered calls. But the other thing I noticed was on both AMD and Micron, if we take a look at the premiums for selling covered calls for a weekly this week of October 2nd, my strike or my cost basis right now on AMD is $84. So I'd want to sell it for at least, or I should say at most, at $84 strike. So just for argument's sake, right now I would collect $35 in premium for selling an 84 strike that expires this Friday. So you would think, like my Micron example I just showed you, that would be the best option to sell weekly, because as we saw with Micron, the 2 weeks out is really not an efficient use of premium. But if we take a look at the option premiums for next week, so let's see, we would collect $35 in premium for selling an 84 strike covered call that expires this Friday. If I go out to next week, for that same strike value at $84, I would collect $114, right? That's more than double the week's premium for this week. So $1.14 or $114 divided by 2 weeks, I would collect $57 per week on average, as opposed to just collecting $35 for this week alone. So selling the 1 week option for AMD, and actually Space or Virgin Galactic is the same way, doesn't make sense. It's actually more efficient use of my capital. I get more average weekly return by selling an October 9th expiration 2 weeks out. Now, let's see if that holds up if I go 3 weeks out. So just keep in mind that we are going to collect potentially, right here, $114 for an 84 strike for October 9th. If I go another week out for October 16th, the 84 strike is now $175. So that would work out to $175 divided by 3 weeks, $58 in premium. So I can actually collect $1 more average per week potentially in max profit by selling 3 weeks out. So let's see how far that goes. So October 23rd, another week out, if I go to the 84 strike, that's $228. So $228 divided by 4, so that's $57 again. So pretty much the same. If I do another week out, October 30th, 5 weeks out, let's see what happens. So again, that's $395 right here, divided by divided by 5 weeks, that's $79 in premium, right? So the monthly option right now at October 30th is actually the best efficient use of my capital in terms of an average weekly return. So that's interesting. Now, the other interesting thing to keep in mind is AMD actually on October 8th, so that is going to be the following Thursday, they're going to release their new Zen 3 CPU specs. And then again on October 28th, they're going to release their new RX 6000 series of GPU specs. So some potential catalysts in the month of October to boost AMD's share price. Now let's just take a look at the TradingView chart on AMD, because right now we've been trading this range between about $74 and $78. And as we can see on Friday, we basically closed right at this level of resistance. So if good news comes out, or if the market decides it's going to rally or kind of increase the share price as a run-up to this news conference on October 8th, well, we might break above the 78 strike. And if that's the case, the next area of resistance is going to be about $80, because we have this trend line here, but also the 21-day moving average as well. So my concern would be, let's say I sell a monthly option at the 84 strike, and if we have a great session on October 8th because the CPU has great specs at a great price point, and the new GPU unveil also has great specs at a great price point, Well, what if by end of October, AMD shoots up all the way back up to the 90s again? Well, if I have a covered call at 84, I would have to worry about now rolling my option out further in time or just basically leave money on the table. So that's kind of the discussion I'm having with myself right now is, do I risk AMD kind of rocketing up in price off good news this month? Or do I chase the higher average weekly returns by selling a monthly? Right now, I'm kind of leaning towards going 2 weeks out at a time because I don't want to leave a lot of money on the table. Because let's say AMD goes to $90, right? And I sold potentially my shares off at 84. That means I left $6 per share on the table times 200 shares. That means I would have left $1,200 on the table if I don't roll my options out. Plus, even if I roll to a higher strike, I might be able to roll to 85, maybe 86. There's no way I would be able to roll to 90 without going super far out in time. So that's kind of the struggle. If I only go and sell covered calls 2 weeks out, well, I'm giving AMD less time to kind of move against me. Now, the downside to that is, what if AMD has bad news and we find out their CPUs and GPUs are not that great and AMD sells off? Well, if I only sell covered call 2 weeks out and then AMD sells off, it's going to be really harder to collect more premium the next time I sell covered calls, because I'm going to have to be closer to the share price and further away from my cost basis. So it's going to be riskier. Whereas if I sell a monthly call at 84, and let's say AMD just drops to like 64, well, I've locked in 1 month's worth of premium. And actually, if it drops that far, I might be able to close out that position early, not have to wait the full 4 weeks or 5 weeks, maybe close it out in 2 or 3 weeks because they might be at a penny already at that point, and then open up some more covered calls earlier. So that's kind of the risk or the gamble you take, or the decision you have to make in terms of how to choose which expiration you want to sell covered calls on, for example, for AMD. So I think right now, to kind of get a little bit of the best of both worlds, I'm leaning towards right now selling covered calls that are 2 weeks out, because I also think that depending on how the news conference goes on October 8th might set up the stage for how we do on October 28th. And if we have a huge run up to, let's say, in the 80s, now to get to 84, AMD would have to break through this area of resistance at 78, this area of resistance and the 21-day moving average at 80, and then also this area of resistance, which is pretty much at 83, 84. So I think that would be pretty hard to do in 2 weeks unless we have a huge run up to this Zen 3 architecture reveal this coming Thursday, or I should say next Thursday. But those are really my options trading ideas for this week. Not a lot of earnings coming out this week, but I am planning on selling covered calls on both AMD and Virgin Galactic. And the situation is pretty much similar with Virgin Galactic. If I take a look at space here, same thing. My cost basis is at about 1786. Right now, we closed Friday at 1643. So again, all depends on, do I want to sell weeklies or monthlies or 2 weeks out? Because it's a similar setup. We have a resistance line, the 21-day moving average, and also another resistance line before we get to my share price of $19, which is where I was assigned. But my cost basis through the selling of covered calls for the past 2 months is less than $18. So same situation with space. Probably whatever I decide with AMD, I'll probably do the same with space. Keep following my videos. I'll let you know what I do. But as always, if you have any questions or comments, leave them below, and happy trading.